that means most likely that the transaction won't happen. There are exceptions. People, borrow in other ways, but that's basically your menu of residential real estate options. And commercial real estate doesn't work that way at all, because the dollars are bigger and the participants are a bit more sophisticated. So there's really two scenarios that play out in commercial real estate. The first is when that shortfall is recognized. So I've changed the math here to be a little more reflective of recent reality, that the bank might say, I'll give you a $65 loan against this $100 commercial property, and the borrower may have $20. And when they identify that shortfall, this scenario is where the buyer or their broker will bring in somebody like us to provide preferred or structured equity to solve that gap. You can also do just joint venture equity, obviously, but today we're going to talk about the middle of the stack, so we won't be as focused on that piece of it. The second scenario in commercial real estate is kind of the reverse. That same shortfall occurs, but instead of the buyer or their broker trying to solve it, the bank actually solves it behind the scenes by calling us and asking us to co-originate a mezzanine loan with that first mortgage lender, so that we provide a combined financing package to meet that borrower need. And that'll happen where a bank likes the transaction, likes the sponsor, likes the market, the property, but just isn't going to get to the proceeds level that the borrower needs to make a transaction happen. So those were examples of acquisitions, but I wanted to highlight that's only a piece of when this occurs. We will fund preferred equity, structured equity, mezzanine loans, B notes, which we may talk about, for all of these different reasons. Just as often as you have an acquisition need, you have a refinancing need. And in this day and age, there are going to be quite a few refinancing shortfalls where the new mortgage loan is less than the old one. And we can work to fill that gap, recapitalizing a property in its entirety, buying out a partner. And sometimes these are triggered by leasing needs. Maybe the property has good news money, a new tenant to come in, but the owner doesn't have the tenant improvement and leasing commission dollars. So that's at its highest level what we do with a lot of our funds. But as I said, we'll get into more detail. So just quickly about me, I tell people I'm from Colorado. This is what goes through their head. No, I'm from Colorado, which is this part. I went to school in the Bay Area, moved to Washington, D.C. in 1994, and started working with a company called LaSalle Advisors, which is now Jones Lang LaSalle. I covered the West Coast commercial real estate for them. I left LaSalle with a group of investment bankers from Goldman Sachs, and we went to a firm called Donaldson, Lufkin and Jenrette. And my job there was to fly back and forth to Tokyo every 2 weeks and buy Japanese real estate, either hard asset loans, non-performing loans, or companies in bankruptcy. And then my wife became pregnant in 2002. We had been acquired by Credit Suisse a couple of years earlier, and my wife didn't want to move to Japan, which is what they wanted me to do. So we moved to Portland. In 2002, I teamed up with a company called Norris Beggs and Simpson and formed Morrison Street Capital, which manages a series of commercial real estate funds. So my whole career has been doing this, and I am truly a real estate nerd, and hopefully you'll get a sense of that today. When we started in 2002, we've raised about $775 million in equity since then, invested most of that. But because of what we do, where we're a lot of times in the middle of the capital stack, we actually have more capital invested alongside us or junior to us from third-party sponsors or borrowers, and then about 64% first mortgage debt. So over the last 20 years, we've invested in a $5 billion portfolio of real estate that was about 64% first mortgage loan to value. We've made 177 investments and sold 129 of them. What's happened now in terms of market conditions is, so this is the capital stack. This is an example of a stack. Vertically, 0% loan to value up to 100% loan to value. So if that property is $100, Prior to March of 2022, you could have gotten a $70 mortgage to office, retail, multifamily, industrial at 4% interest. And if the borrower had 20% equity, the gap was very small. It was 10% loan to value from 70 to 80%. And we would charge 12% interest rates, effective interest rates, to be in that gap. That meant that the borrower's blended cost of 80% financing was 5%. So not bad. Today, the market's adjusting. So let's say that the value of the property is $90, not $100, and the borrower still only has 20% equity. Now we have a 20% loan to value shortfall because the lender has pulled back to 60%. And that means there's a wider capital gap. And if the cost were the same, that borrower's blended cost of capital has gone up, but their need for capital has gone up quite a bit. So when we play that out, why would we invest in the middle of the stack like that? It's to adjust risk and return together. So we're not interested in the 4 or 5.5% first mortgage returns, too low for what we want to do. But sometimes, we don't want to take equity risk and be the owner. That's most of the time. So the way we view it is that borrower's 20% equity is kind of a 20% layer of insulation or a cushion to value decline. So our position in this example, where markets have retrenched a little bit, would be from 60% of the value of the property to 80. And that means from our first dollar of loss, we've got a 20% cushion, into our last dollar is 40%. Same would be true of preferred equity. Now, the one thing that's really counterintuitive, I find hangs people up the most when we do this, is that the payments and the control work in opposite direction. So everybody, realizes that when you have a property that you own subject to a mortgage, that mortgage has to be paid first. Then you would have to pay our debt or equity out of our fund if you're that borrower, and then the borrower can take that payment. But the control is actually the exact opposite direction. The first mortgage lender has a senior economic position, but the borrower's in control of their property, not the lender. So as long as the borrower's in compliance with all the debt covenants and payments, they're in control. And if they default, then it becomes us, not the mortgage holder. And only if we default would it then revert to the mortgage holder. So from an underwriting perspective, when transactions come to us, we're agnostic on kind of how they come in. It may be an equity request. A borrower wants to partner with us to buy the property. Could be a preferred equity request, a mezzanine loan request. And what we do is a top-down and bottom-up analysis to decide which structure we should be using. So we care a lot about fundamentals of markets, properties, borrowers, and we look at all of those factors down to the granular, underwriting of the property with its environmental and structural reports and rent rolls, and look at those things. But to us, you only make an equity investment. You only become the owner when the vast majority of those indicators are favorable. If you like most of the property, but either the borrower doesn't want us to be their full partner, or we want to protect a little risk, we'll use structured equity, which I'll describe later. And then if we like everything, but we're just totally uncomfortable with the basis in the property, then we'll go to preferred equity. So our little checklist is, do we like that market? Do we like the property? Do we like the sponsor? Does the structure work? And where we get hung up the most is on pricing. We're pretty picky. So if we just don't like the price being paid, then we're going to want to try some other structure to make a transaction work. And what that means is that our investments come from places that not everyone might think of. So if you think of an investment broker, somebody just listing a property for sale, that's only 10% of our deal flow by either volume or dollar. And most of it comes from senior mortgage lenders calling us and wanting to be their partner. That'd be all the big Wall Street banks, or a mortgage broker representing borrower or lender. We find a lot of them through direct relationships we have ourselves. We invest in securities, so those are bond trading relationships, and then just the underlying operating partner themselves. So we kind of construct our portfolio from a different pipeline than is typical. And the result of that is that only 14% of our capital historically has gone into buying real estate. The other 86% is in financing it in some way, shape, or form. We tend to reflect the market somewhat historically, meaning the market cap of various sectors. We are less constructive on office than ever before, and more bullish on other sectors now. One really important feature is that we don't do really much in the way of development at all. We're mostly a stable property investor where there are leases and income. And we invest coast to coast in all those in the four main food groups: office, industrial, retail, apartments, and then in all sorts of other specialty property types. So the way that we organize this, and then I'll get to how all of it works, is we invest through two different channels. The lenders coming to us to partner on financing takes the form of a mezzanine loan, a B note, or we'll invest in securities. And those are sort of standalone instruments where we have a loan to the borrower, but we also have a relationship with the first mortgage lender as to how all the parties work together. When the borrower calls us and wants help, we go in as preferred equity. So we're actually in the borrowing entity, in the ownership entity, but we're preferred stock. So there are two different forms of collateral, and they achieve two different things. The debt creates long-term, high-yielding fixed income, and the equity does what you would expect. It's real estate investment, a little bit more inflation hedging characteristic, but we're still trying to de-risk it by being at 80% of the value of properties and not 100. When you kind of step back and look at all that in our terms of our deal flow, I mean, I realize the math isn't quite like this. You can look at dollars or investments, but we think of it as being half in equity and half in fixed income as to what we're doing. Last thing about how we organize that is that our loans tend to be 10 years fixed rate, double-digit coupons. And they're heavily call protected, meaning that the borrower can't pay it without some kind of defeasance or yield maintenance that preserves the yield to maturity. When we invest in preferred equity, we take the opposite approach. They're shorter investments, 3 to 7 years. We allow the borrowers to prepay, but there's a minimum profit multiple, and that serves to increase the IRR, the compound annual return if they prepay. And then if they don't, we would just make more profit multiple through a longer holding period. But we're trying to accomplish two very different things with these two channels: create fixed income yield and create more equity exposure through the preferred and structured equity. So Daniel, I was going to pause real quick and see, do I need to field questions now or should I keep going to the end? Uh-oh.
Daniel, you're on mute.
Thank you. I was going to say, feel free to put your questions in the chat, and maybe I could start with just a couple of questions here, because not everybody is going to be familiar with some of the terms that are here, such as mezzanine debt, preferred equity. Maybe we can go through kind of a one-on-one primer on some of the vocabulary here and kind of describe, you've gone through your process here, but maybe on a more basic level, what these things do.
Okay. I'll do that as I walk up this chart, I think.
Perfect.
So this is what we call an efficient frontier. It's trying to measure risk and return. So risk increases as you go up the left side, and return increases as you go this way. So when we start at the bottom left with the lowest risk and the lowest return, that's going to be a mortgage to commercial real estate. So first mortgage, just like you'd think of in the home context, you have a life insurance company, a bank, somebody who makes that loan. It had been 3 to 5% on this range. Now we're much more often seeing 5 to 6. given, quantitative tightening over the last year. That is just not a space we play in very much, but that one I think is the easiest to understand. When we get to CMBS, those are commercial mortgage-backed securities, and those are a first mortgage that is cut into different risk and return. So without making you too dizzy, I'm going to go back real quick and explain that one. This you might remember from residential securities sort of during the 2008, 2009 crisis. Commercial didn't have the same problems, but it had the concept where you can take a first mortgage that's, in this case, 65% of the value of the property and cut it into tranches of risk and return. So the lower the loan to value you go, the lower the yield on that bond. And once you get up to 65%, you might be getting closer to double-digit returns there. But when you blend out kind of what could you get as a bondholder in that space, we haven't invested in that space since 2009 because the yields are probably 5 to 7% current in the junior bond classes with maybe a 6 to 10% yield to maturity. And they're also very difficult for individuals to buy. So that's what that represents. A B note is a part of a first mortgage. So what you would do is the lender, let's say, Bank of America makes a 65% first mortgage loan, but doesn't actually want all of that. It could call us and say, do you want to take the 65 to 55% piece? The borrower would make one payment, have no idea that we owned the B note, and that B note would then, the borrower make one payment, and then B of A would keep the A note payment and give us the B note payment. And those are generally in the 8 to 10% yield range. Then a mezzanine loan is a standalone note. And that's where we make a loan to the borrower and the first mortgage lender makes the loan to the borrower in two different amounts. We then certificate that loan, which means we turn it into stock. We certificate the ownership, which is the equity. We certificate that. The borrower pledges those stock securities to us under the mezzanine loan. And then if we need to foreclose, rather than foreclosing on the property, we foreclose on the ownership of the property and take title that way. And that's how we protect our collateral there. And that's in the range of 10 to 12% today. Then when you go to preferred equity, notice the box is different. So we had debt here, and now we have equity. And the reason is that now I've moved into the equity collateral bucket where I have a 65% first mortgage. I no longer have debt. I have equity, but I'm senior class of stock within that. So it's just like preferred stock in a company. The difference is if something goes wrong, which we hope it doesn't, we don't have to really foreclose. We're already the owner. We just take more control because we're in that ownership entity. And the beauty of preferred equity, the reason it's kind of our favorite on this efficient frontier, is that it would have an 8 to 10% current interest rate a lot of the times, accrue to maybe 11 to 14. But because of the prepayment penalties attached to it, they prepay about half the time, and that serves to increase our returns. So that's why you see two dots here. These are the ones that don't prepay, and these are the ones that prepay. Then structured equity, I'll describe more in a few slides. It's where we would get a lower current return and have more of a profit participation. And then equity is just being the owner of real estate. Sometimes lower cash flow because you're reinvesting in the property, but your hope is that your total return is better. As I will show you at the end, we find our best combinations of risk and returns are kind of here in the middle, and we do less on the ends of that spectrum. So that's where we talked about getting to an understanding of this chart. Is hopefully when we started at the beginning, you saw with residential, it's kind of simple. You just have mortgage and you have equity. With commercial, you can do it that way, but there's lots of other tools we can use to invest in the middle of that capital structure. So the way that that ends up underwriting, this is where I promised to get more complicated. Here we go. Is that if you have that same property value of 100, a cap rate is the unleveraged yield on that property. So let's say the net income of that property is $6.50. You have a 6.5 yield. The way the first mortgage lender actually looks at it is not what most of us think of day to day. To them, that's a 10.83% cap rate, and they will refer to that as a debt yield. It's not the yield they're earning on their loan. It's the unleveraged yield of the property divided by their loan amount, $60. So the borrower has $6.50 of income on $100. The mortgage holder has $6.50 on $60. So they view that as a much safer basis. And then they look at debt service coverage. So the lender says there's $6.50 of net income. How much is the mortgage payment in this 5.5% interest example? I'm almost 2 times covered for debt service, means that the $6.50 of income is almost twice what's needed to pay the debt. So this is a loan that lender will make. The way we look at it is we're in the middle. So we think of it the same way a lender does, but with different math. The borrower has the same math they had, the lender has the same math. Our math is we have 6.5 divided by 80, so we're an 8.13 cap rate. So it's much less risk at that cap rate than at paying market value. But in comparison to the first mortgage lender, who had 2 times income to debt service, we only have about 1.18 in this example if we charge a full 11%. So a lot of times that's why what we'll do is we'll move it down toward 8, 9, or 10% and then accrue the difference to a higher rate. So we put less pressure on the property day one and give it time to create value. And then what happens to the preferred equity? The reason there's upside in doing this strategy is of our 52 preferred equity investments, 24 of them have prepaid. And when they do, the IRR, the compound annual return, goes up quickly. So the way we'll size something is we'll say, here's a 5-year loan for 7 years. We're going to charge 8% a year. It's going to accrue to 12. There's a 1% fee up front. But the borrower has what's called a make-whole or a yield maintenance penalty. Whenever they prepay us, we're normally expecting our money to be outstanding for at least 3 years. So we just kind of size it and go, look, we want 3 or 4 years of payments. That's the minimum. When you look back after 3 or 4 years, what did we earn? So 1.45 times after 2 years is a 22% return. And as we go out over time, our yield comes down to 12.9, but our profit multiple goes up, and there's no prepayment to the borrower in that case. So that's how preferred equity ends up being kind of the most return efficient. And then what this describes is what we call a waterfall. Whoops. It's how we split cash flows with a borrower. So with preferred equity, when you go to sell or refinance the property, we would have to get, you pay the first mortgage debt, then you return our preferred equity. We would get our 8% preferred rate, our 4% accrual rate, any kind of penalty, and then the borrower gets everything else. In structured equity, it's a hybrid between equity and preferred. And the way it works here is that we would get our money back, then we would let the sponsor, the borrower, get their money back, then we would get an 8% preferred return, then they would, and then we would split the profits. So we still have some upside potential. We haven't protected our profits in full. We've risked them, but we've protected our principal in full. So,
hey, so
yeah, go ahead.
We do have a couple of questions that are in the chat, and I'll get to those in a moment. And if you have questions, please put them in the chat. But I wanted to start off with, you've given us a lot of information here, and I want to really connect this to the people that are here. And so I'll ask you straight out, how do you help outside investors invest, or do you work with outside investors?
We do. So we invest on behalf of sort of every investor type. We have foundations, endowments, corporate pension plans, city, state, county type plans, lots of high net worth investors directly with us, lots that come through financial advisors or consulting firms, half, taxable, half tax exempt. We kind of work with everything. We'll have things as small investments through IRAs with a custodian, self-directed, all the way up to, very large capital commitments from university foundations. So we are kind of open to all investor types. We do organize our funds into two completely different channels, as I was describing. There's a perpetually open fixed income fund, and then there's a series of closed-end preferred equity funds. So we call our fixed income fund the Morrison Street Income Fund, and then we're on Fund 7 in the equity, preferred equity, structured equity space. And those closed-end funds, they tend to just invest over a couple of years, try to return capital in 4 years, have profits in years 5, 6, and 7, and wind down. And then the open-end fund is just evergreen. People come in and come out of it depending on valuation of the fund at that time.
How often do you bring a new closed-end fund out for public investors?
About every 2 years.
Okay.
So we have, both are open right now. Well, the fixed income fund's always open, and we're raising capital. We just started in November for Fund 7. So it'll raise capital through 2023, and then it will close. And then once it's finished investing, which might be mid-24, then we would start Fund 8.
Okay. So I'm going to get to some of the questions that are in the chat here. And of course, we've got to start off with the ubiquitous question that every investor asks. What do you think is going to happen to interest rates?
So we have a long-standing house view that interest rates, we've been in a long secular decline in rates because as developed countries hit stabilization and maturity, they become more leveraged, and the economy can't afford the same level of debt service that it could before. So if you compare 1980, very high interest rates, that debt service load on the economy was far less than it is now with the interest rates we have, because we've become so much more leveraged in the meantime. So if you ever tried to have the interest rates of the 1980s here again, it would just shut down the economy. I mean, it'd be a depression. And I think that's what we've seen play out in Japan. That's what we've seen play out in Europe. It's just as these economies mature and get leveraged, they structurally get stuck at a lower interest rate level. The second the Fed lets rates rise too much, car loans are more expensive, home loans, credit card debt, student loans, treasury debt, everything becomes a bigger burden on the economy. And we find that when we model that out, the economy hits a pretty natural resistance point about where we are now. And that where we are now is pushing the economy as hard as it would have been, in the 80s. So that's our house view, is that eventually, if the Fed goes too far, which they would be getting close now, they would just tip the economy into recession and have no choice but to ease again. That's our view. Not everybody has to agree with it. That's just our view.
I guess the follow-up question to that is, do you think they've raised interest rates enough to tame inflation?
Well, so that's the other thing. We have,
again, crystal ball.
Yeah. So we actually have published, we published in November of 21, forecast of interest rates and inflation. And we said that inflation was going to come, roaring through 22, simply because of the amount, the $10 trillion in fiscal and monetary stimulus that went into the economy. There's no way not to create inflation. Nobody had ever tried that level of stimulus in human history compared to the size of the economy. And it had to create inflation. It had the compounded effect of hitting supply chains. But now I think there's a disconnect. I think most things are deflating. But what we have is a different problem where the labor market is tight because we just don't have a high enough labor force participation. We don't have as many people working as we used to. And so I think that you're seeing sectors of the economy deflate, but we may not be able to anytime soon get back to 2% growth, 2% inflation. We may be dealing with 2% growth, 4% inflation at some point. And it's not ideal. And one of the reasons that could happen to us is tight labor market, because we don't have enough people working. We're not immigrating as much as we used to. So we're not getting growth from there. And we actually are flat to slightly down in population last year and this year for the first time in history. So we're not getting growth we're not getting it organically, births minus deaths. We're not getting in-migration to the degree we need. And we have a tight labor market. So I think that's where you're going to continue to see the inflationary pressure.
So when you say 2% growth, 4% inflation, along with the labor pressures, are you using the word stagflation, or is it that not it?
Yeah, I guess so. I think eventually what ends up happening is when you bounce along in that territory, you get enough layoffs that you get labor market slack again. And then that's when you finally get back to 2 and 2.
Mm-hmm.
I've sort of felt like for a long time that the 2s were the rule of thumb, 2% 10-year treasury, 2% GDP growth, 2% inflation is probably where a highly leveraged economy like ours would operate. But temporarily, we can't get back to that because we pumped too much money into the economy. So we're stuck at 4% and 2% for a while. That would be our assessment.
Okay. Ashish is asking the question, as interest rates rise, do the rates that you're charging your borrowers rise as well?
Yeah, that's a great question. I wish it was as easy as saying yes. It's really not, because if you go back to that coverage math, we want to write loans that would perform. So if we tried to inject into here our capital at 15% instead of 11, that we couldn't cover debt service. And we don't want to make a transaction that sets the borrower or us up for failure. So as interest rates rise, we tend to keep our cost of capital about the same. And where we'll try to make up that difference is in profit participation. So we'll do more structured equity. If the asset succeeds, we'll get some upside. And we may increase the accrual rate. But whereas a year ago, Ashish, we could have charged 12% on every investment and it would have covered debt service. We're finding more often now, we actually have to charge 8 as a current interest rate and then accrue to get to our 12, because we don't want to immediately put the property under pressure. So there's a natural tension built in between when you're in the middle of the stack like that. You have to find your profits through prepayment penalties and through profit participations, but you can't necessarily get it in interest unless you just want to, be a loan to own type lender. And we don't want to do that. We want our loans to perform.
All right. Ashish follows up with another question, and I'm going to add to it a little bit, but why do borrowers prepay if there's a penalty? And I'll say that you brought up the idea of prepayment penalties on commercial loans, which is something that not everybody would necessarily be familiar with. You use the term defeasance and yield maintenance. Can you explain what those are, and why would a borrower pay if there are penalties involved? And why do you as the lender want to impose penalties? Why isn't that in the residential market?
Yeah, great questions. Okay, so take them in different tranches. So if you're a lender, you view it as the borrower's using your capital. So what are you going to get paid for the use of that capital? And lenders who would fund a short-term loan would say, I don't really need prepayment penalties because I'm expecting that money to come back soon and I'll reinvest in something different. When you make a long-term loan, like a 10-year loan, you're asking that lender to tie up their capital for a long time. So they would have a certain expectation of how that investment would perform. And what I mean by that is a 10-year loan is traditionally going to be funded by a life insurance company who's matching assets and liabilities. So they say, if for 10 years of my capital, I have to earn this return, they put it in their actuarial tables. And that means when you prepay, they need to know that either they can reinvest at that same level or that you've paid them to compensate them for that prepayment. Similarly, first mortgages will get securitized and sold as bonds. And the bondholder is probably a life insurance company buying the bond for the very same reason and saying, I need to meet my actuarial return, or I'm a pension fund that needs to do that. So if you pay me early, and rates have gone up, there's no penalty. I'll let you out of it. But if rates have gone down and I'm going to have to reinvest at a lower rate, borrower, you have to make up the difference to me. The two different processes are yield maintenance would be you just pay me a specified penalty. Defeasance is a crazy process that applies to most of our loans. It's where if we make a 10-year loan to the borrower at 10% interest, they owe us 10 years of payments at 10% interest. And if they want to prepay it, they need to defease it, which means replace the loan collateral with some other collateral. And the only collateral we would accept are treasuries. So imagine buying a basket of treasuries that yields 10%. You'd have to buy, many more treasuries than the amount of your mortgage loan. So it makes it more likely that the loan will just stay outstanding. But for the borrower that thinks they're not going to hold the property for 10 years and they want to refinance or they want to sell, they're going to want a shorter term investment. And that's where our preferred equity would come into play, where we would say, prepay it whenever you want, as long as it's after 12 months, because we do want capital gain and not ordinary income. But after 12 months, you pay it however you want. It's just that you asked us, borrower, to give you a 3 to 7 year loan. So we're tying up our capital for 3 years with you. We need to earn 3 years of payments. So if you pay it in the second year, you're still making 3 years of payments. Then once you get past the third year, there is no penalty. And so why does the borrower do it and why do they prepay? They do it because they want the flexibility to have the capital longer but pay it sooner. And then honestly, they just never foresee the scenario that they are going to pay. So the reasons it happens in a good market, they might lease up the property faster than they expect, get an offer higher than they expect, or be able to refinance sooner than they expect. And they do that math and they go, even though I'm paying the prepayment penalty, my returns as the owner are better to refinance or sell and pay the penalty than to wait and not pay the penalty. So that's one outcome. But the outcomes are pretty varied. We've had people prepay because they had some underlying dispute in their partnership and they wanted to recapitalize or buy somebody out and go with a new capital structure. We also will have people prepay because they are in default and actually want to prevent the process of us taking over. So they have some other source of capital and they just come in and pay us off. And in those cases, we still get the penalty. The most extreme example, we made a 7-year loan that had a 1.6 profit guarantee in it, and they paid us off in 4 months. And it was because their partners got an offer that they couldn't refuse, and they took it and paid us off 4 months after putting in place a 7-year loan. So you just never know. Should I keep going or more questions?
There's a few more questions here. You mentioned a little bit earlier. I'm not on mute, am I? Okay, you can hear
Nope.
me. You mentioned a little bit earlier that your interest rates had come down to around 8%, but that you needed to accrue it back up to 12. Can you explain what you meant by that?
So what you do is you bifurcate the loan into two amounts. The portion that has to be paid annually. So if you have a $100 loan, they have to pay $8 a year during the term of the loan. But when the loan is ultimately retired, they have to make up the $4 shortfall every year. So they actually even have the option. They can pay 12 if they want. Like if the property does better than they think and they want to pay 12 a year, they can do that. Or they can pay 8, accrue 4, which means that it gets added to the loan balance. So now instead of having a $100 loan, it's effectively like 104. And it that interest compounds so that at the end of the day, we got a 12% compound annual return, even though they were only paying 8 a year. So it's easier for the borrower to make an 8% payment. It keeps the property in better performing status, but at the end of the day, it doesn't require us to compromise down to an 8% return. We just give them more time to do it so that as they grow the property NOI, they have a better chance of refinancing down the road.
All right. Glenn is asking, he mentions the gap that exists borrower to first note where you operate. Can you talk more about the type of customer that uses you versus higher quality equity raises and eliminating the gap? I'm not sure I completely understood that, but maybe you did.
I think I do, yeah. So borrowers have a choice in how to optimize their capital structures, and we get used for everything you'd imagine. Our average investment for preferred would probably be $5 million. And our average, and I'm not talking about property value, the check that we would write would be $5 million. So that might mean that the property is, $25 to $50 million. And then our average investment in mezzanine loan is $6 million. And that actually means that the property is about $100 million. So these are very large institutional assets on average with sophisticated sponsors. So they will do it for a number of reasons. Some of them look at equity and say, okay, my equity partner that I have, I'm going to have to give them half the profits. They're going to be half, I'm going to be half. They take half the profits. If I run my math through the model and I pay Morrison Street this preferred return thing, it doesn't quite amount to half my profits. So I'm going to keep more money. So they'll do it out of, I would say that's greed, which not in a bad way. It's just trying to say, I want to keep more of the profits. Or they'll do it through IRR maximization, like compound annual return. And they'll look at that math and go, okay, I used to get 5% as a blended cost of debt. Now it's 7%, but 7% blended cost of capital or 12% on the mezz loan is still less than the effective cost of capital of my equity. And so they're actually incredibly sophisticated people who are maximizing risk and return for their investors by figuring that out. But you will have cases as well where the sponsor's really good and they just think, hey, equity raise takes resources for me. I could raise $10 million and buy this property, or I could raise $5 million, have Morrison Street put in $5 million, then I can go do another investment with $5 million from my investors. So they're trying to spread their resources as widely as possible. And then you get to the really bottom line answer sometimes that in the home mortgage gap, the reason you see it happen less, that a transaction fails, is somebody might be short $50,000 and they come up with it somehow. But when our average is $5 or $6 million, I don't know about you guys, but I don't have $5 or $6 million in my pocket right now. So sometimes they just don't have that gap. And an equity raise may take more time, and we can come in and do due diligence quickly and fund that gap in a hurry is a huge benefit to them. So we get everything you can think of. We lend to other funds, we lend to REITs, we lend to family real estate companies, but they tend to be, this is a lot of, call it $20 to $100 million properties. It's generally in that range.
All right, we've got 5 minutes left. Rance, can you let people know how to reach out to you and Morrison Street Capital?
Yeah, let's see if I
assuming you want them to.
Yes. So here's my phone number and email address. My email is usually the best. It's very long. It's rgregory@morrisonstreetcapital.com. And my phone number there, 503-952-0745. And our website's a good resource as well. These are, a couple of examples of recent transactions we've made. You can see, that's 1.1 million square feet of industrial, student housing in Bloomington, Indiana, some flex and business park outside Atlanta. Just made kind of a shorter term investment in Vancouver, Washington. And we have another pending industrial transaction in Atlanta. So we're working on a lot as we speak that have these very same characteristics we're talking about.
All right. Hey, everybody, can you take yourselves off mute and thank Rance for coming in and speaking to us today?
Thanks, Rance.
Thank you.
Rance.
Thank you.
Thanks, Rance. Everybody.
Thank you, Rance.
Thank you.
Thank you. Thanks so much, Rance.
Thank you, everybody. And just a quick reminder to get upcoming emails for events, please go to that form that I sent out. Somebody wants to come in right now. That's interesting. And I would love it, of course, if you leave me a testimonial. Have a great weekend, everyone.
Thanks, Daniel. You too.
Thanks, Daniel.